All right, welcome back. You're watching The Money Show. I'm Kavita Thapliyal, and today we are going to talk about REITs and InvITs. So, what exactly has happened is with the amendments in the Finance Bill 2023, taxation of real estate investment trust and infrastructure investment trust has undergone a key change. The loan repayment distribution component from REITs and InvITs now need not be treated as income from other sources, but instead gets a capital gains tax treatment for a certain number of years. Let's welcome on board Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth, to talk more on this. Feroz, this can be slightly complicated for investors to understand, but then before we get on the change in the taxation part, let's talk about the kind of investment instruments REITs and InvITs are. So let's start with REITs.
Yes, Kavita, these are liquid real estate instruments.
Okay.
Basically, the biggest problem with real estate is illiquidity and size. REITs have tried to address that two big issues which real estate as an asset class undergoes, right? If you're going to buy a home, it's going to be a large amount of money and you're not going to be able to sell it over the counter. So REITs are nothing but mutual funds kind of instruments or pooled vehicles which invest in real estate. Unlike a mutual fund which invests in gold, real estate, debt, and equity, REIT invests only in real estate. Basically, it's a listed instrument. There is a group of SPVs or REIT in real estate investment which are pooled together and they're listed. To name a few, there's Embassy REIT, there is a Brookfield REIT, and a Mindtree REIT which are listed. And I think the first REIT was the Embassy REIT a few years back, listed at about 300 odd rupees, and it's at about 330, 340 rupees today. And it gives you a regular income. So REIT is defined as a vehicle which consolidates real estate investments, and there's somebody managing it for you, and those are liquid, and they're in small quantums. You can buy and sell them for as little as 300, 400, 500 rupees.
Feroz, why do you think a retail investor should be interested in something like a REITs or InvITs?
See, I think retail investors love to have some degree of regular income, especially in the latter part of their years. So REIT has this feature of giving you some degree of regular income because REITs more or less try and consolidate commercial property, which is beyond the reach of a retail investor. So the asset class which we are speaking about, most retail investors can never invest during their lifetimes because commercial real estate is even larger ticket sizes. That's one. Second is regular income generation coming from rental incomes of corporates. That brings in stability. That's number two. Since they are in the lowest tax bracket, there could be tax efficiencies for those dividend payouts. And these could, because it's reasonably tax efficient for a person who's not in the highest tax bracket. These could be the three reasons why a retail investor could be interested in these vehicles.
Got it. Let's talk about the change in tax. Earlier, what it was and how has it changed? Is it more investor friendly, or now it is not so investor friendly change that we're talking about?
See, it is it's a tax which impacts the return marginally. Yes, it is detrimental to the investor. That's why you would have seen on the budget day these REITs actually fell on the stock exchange by a reasonable quantum. Generally, they're not as volatile as they were on the day of the budget. Which was 1st February 2023. Now coming to what's the change, Kavita? The change is as follows. Whenever a property gets sold inside a REIT, there could be a loan outstanding for that property. The loan which actually is repaid, you have to reduce it from the cost of acquisition. Let's assume you had bought a property at 100 rupees and you had taken a certain loan. You sold it at 200 rupees. So the gain was 100 rupees, 100 mein kharida, 200 mein becha, the gain was 100. Now let's assume after you got your 200, you paid back a 50 rupee loan. So now you have to, your cost of acquisition of 100 comes down to the extent of the loan repayment. So now your cost of acquisition will become 50 rupees. So 50 becomes your cost of acquisition, not 100. So instead of paying tax on 200 minus 100, now you will have to pay tax on 200 minus 150, which is a higher tax liability. So this was the change, and this would probably have the potential to impact the return by about 0.5 to 0.7% per annum for a REIT in the long run.
What about InvITs, the similar kind of change we are talking about?
InvITs, the change is identical. They are more or less infrastructure projects. Like REITs are commercial real estate projects where private sector corporates could have borrowed or rented out those or leased out those properties for long periods of time. InvITs, as the abbreviation goes, it's investment trusts, which are more infrastructure related.
Between the two of them, REITs and InvITs, which one do you think investors can be more comfortable in picking? One, we are talking about infrastructure projects, which could be like a theme-based investment if at all they want that kind of a flavor in their portfolio. But then talking about REITs, it's more about real estate, which also talks about diversifying in a particular asset class.
I think the first step for a retail investor would be a REIT, and then he or she can graduate to an InvIT later on, because the complexity involved in an infrastructure project is not for a common man to comprehend. Infrastructure projects have very different gestation periods, different kinds of lock-ins, different kinds of cash flows. A commercial real estate property is something which most of us are familiar with. So I would say starting with a REIT, and then maybe if you really want to graduate out to something more complex, then it will be InvITs.
Any particular change in the strategy owing to the change in the taxation that an investor needs to do, or there's nothing that one can really do?
No, of course, there's not much you can do, because this taxation is at the fund level. This is not something which at the hands of the investor does it make any difference, but the returns would drop. I personally think that in a high interest rate environment like where we are today, where the corporate government bonds can give you 7.2% pre-tax for a retail investor, and that almost becomes post-tax for a person who's just retired or something. When 7.2 government can give you, the need of a REIT or an InvIT doesn't exist to my mind, unless 10-11% is achieved through these complexities. If interest rates on the government side were at 4%, and if REIT was giving me 8%, then it was remunerative enough for an individual investor to actually go through this complexity and go through the volatility on a daily basis of a listed vehicle, which of course is significantly lower volatile than an equity instrument, but it's still volatile. If I have to numerically put it, it is 60% volatility of Nifty is what an embassy REIT has thrown up for the period it has been listed.
Feroz, so far, how is the investor response in these two investment instruments? Has it been upbeat or very slow response?
No, it's been reasonably upbeat. See, unlike a mutual fund, Kavita, these have limited units. See, in a mutual fund, if I want to tomorrow invest 200 crores in a Kotak Emerging Equities fund, because I want to invest 200 crores, the NAV will not move just because of my demand. But in a REIT, the number of units are fixed. The number of listed shares are fixed. So a larger demand could create a larger price rise and in turn give a capital appreciation to a REIT owner. Which is not the case in mutual fund. Mutual fund, you're dependent on the fund manager's capability. Demand and supply for that mutual fund will not impact the price. So to answer your pointed question, have they generated enough interest? The answer is yes. Have they generated super normal interest? I would say no. Given the love for real estate in India, I would expect a larger demand, but I think it's been subdued. But having said which, it's been not as bad as it could have been.
All right, that was all about REITs and InvITs that we had for our viewers. But then, Feroz, let's move on to our Q&A, because there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? Let's get you all the details on this. But you can send your portfolio queries on our WhatsApp number. In case you're watching us live, you can WhatsApp us on 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So we have Selva Guhan, our first viewer, on phone line with us. Hi, good evening. How are you doing?
Hi, I'm good. Thanks.
Thank you so much for sending us your query. And as I can see, you want to understand what kind of a scheme to select, a regular or a direct scheme, right?
Yes, for a fresher who wants to start the SIP.
All right.
For long term, which one will be best for new joiners?
So you want to know what kind of fund you should be investing in and whether you should be going through a direct scheme or a regular one?
Like the fund as well, the regular or direct, because when we go with direct, we need to register with multiple AMCs.
Right.
So that's the thing, like can we do with regular? What might be the differences for long term? Will it
Also,
affect our portfolio?
sure. In order to recommend a fund to you, I just want to understand your investment time horizon, what's the kind of amount and the corpus are you looking at?
Let's say 1 crore. As a corpus, I plan to invest 5,000 SIP.
Okay. For how many years?
It's like 15
years.
15 years.
All right. Firoz, these are the details for you. But before we answer the fund recommendation part, let's talk about, he sounds like a fresh investor, first-time investor. A regular scheme for him?
No, I would say, Kavita, no, not a regular scheme. If he's looking at your show and taking advice from you, there's no point actually going regular. You're just going to give more money to the asset management companies. Logistically, it's not as difficult. There are quite a few consolidation platforms. You can buy it through BSE Star or MF Utility. You don't have to individually register with each AMC. You can cut one check and make a payment to several AMCs. So I don't think the logistical difference of not having an intermediary is so compelling for you to pay go regular. So point one. Point two, I think, of course, there are plethora of investment opportunities like Kavita always mentions. But I think, Kavita, I have to be honest with you that you've had the passion to pursue personal finance for over a decade as a professional. And I think, Selva, if you're looking at the schemes and deciding them all without the help of another person other than the show, you should never buy regular. Over a period of 10 years, the direct NAV is going to be far more remunerative for you than the regular because the price difference between both these, the portfolios are identical, right? There's no difference in the portfolio, but there's a difference in the cost. If the cost is down by 0.75 to 1%, over a period of 10 years, you're going to almost get 20% or 25% of your total invested amount as an extra return by going into direct as against regular, right? Assuming the scheme choice is not being assisted by an intermediate. So the schemes which you can pick for yourself, I can give you 8 of those, which are tested from a more futuristic standpoint and not just the past performance standpoint. So they may not look very attractive if you look in the rearview mirror. Like a quant active fund for the last 1 year would show you -4%, but it's still in the recommendation list. In fact, reasonably confident that it'll do well from a future standpoint. So HDFC Small Cap, SBI Contra, Quant Active, ICICI Dividend Yield, Kotak Emerging, HDFC Flexi Cap, SBI Large and Mid Cap, and ICICI Focused Equity. These are the funds you can choose to begin with. If you have an amount of 5,000, don't hesitate to have eight AMCs and 8 schemes in your portfolio and keep adding to it as your amounts go up and your incomes too.
Firoz, now since Selva is a fresh investor, first-time investor, a regular scheme would have just gotten him introduced to mutual funds and maybe to the financial instrument that he's looking at. Once he's into a direct scheme, what all from his part he needs to keep tracking in terms of doing the homework? It's not only the the registration issue that he was talking about. He also wants to understand, because once you take a direct scheme, you have to monitor your portfolio, track your funds, make the changes accordingly. What should be his checklist in order to go ahead in this investment journey?
Yes, Kavita, see, the first step of deciding a mutual fund is to decide the mutual fund scheme. If you've already decided, then you can use any technology platform. There are quite a few of the technology platforms which provide direct schemes as an alternative, and they provide you the execution platform at a flat fee, at a marginal flat fee. That's a better choice for you, is what I personally think. If these are the 8 schemes which I rattled out, if that's the one he wants to go ahead with, then he can choose any platform, Google out platforms, fintech platforms, which help him buy units and SIP standing instructions creation for these 8 schemes. And he should choose direct because he already has chosen those schemes, and he does not have to pay the intermediary, which in this case is the fintech platform, which can help him set it up. So he does not have to monitor any more than a regular scheme, because the regular scheme's performance and the direct scheme performance is going to be identical only to the extent of the cost. The direct scheme is going to be greater. So the extent of monitoring a regular scheme will need is exactly the monitoring the direct scheme will need, unless he has chosen an intermediary in the form of a distributor or an advisor whose assistance he chooses to have to manage the schemes.
Let's move on. We have Mr. Sridhar from Coimbatore with us on the phone line. Good evening, sir. How are you doing?
Hello, ma'am. I'm good. Thank you. Thanks for asking. I'm doing great.
Thank you so much for sending us your query.
Yeah.
Okay. I like the fact that you understand the power of equity investments, and you are already investing in mutual funds, 50,000.
About 50,000 in equity mutual funds. To be precise, I'm investing in Canada Robeco Blue Chip Equity, Kotak Emerging Equities Fund, SBI Contra Fund, SBI Small Cap, and Quant Active Fund.
Okay, we don't have the details of these funds, I guess.
Okay. Yes,
Yeah.
I did not,
So,
because my question was very generic, in fact, because my focus shifted to equity ever since the COVID period.
Sure.
Otherwise, I'm not very familiar with the equity investments, because I'm the first person in my family to get into equity kind of investments. So my question was, how can we completely be dependent on equity investments for all of our financial needs that are
Sure.
coming up in the future, in the 20-30 years?
Sure.
That was my question.
Lovely question. I think even other viewers would have a lot of takeaways from this particular question that you've raised, and this is something that comes on everyone's mind, or every investor who wants to, who's planning to set off on a journey related to the equity investments. Feroz, very important question, and I'm glad that Mr. Sridhar actually raised this question, because although most of the time it looks like a very basic thing to ask, but that's the most important thing. How can you trust equity for all of your financial goals? I mean, there has to be a process, a strategy, but then why most of the time equity?
Kavita, see, if you look at equity, Mr. Sridhar should, I'm sure, with the kind of experience he has had, and he's investing 50,000, would have realized that equity has one name, but it's very diverse asset class. A stock of a company which is into IT sector, because he is in IT sector, is going to behave very differently than a stock of a company which is in the FMCG sector. Hindustan Unilever's behavior as a stock is going to be very different than an Infosys, for example. So equity, all of them are called equity. But the diversification of the asset class, because it is businesses could be multiple, could be in different geographies, could be in different sectors. So since equity is the foundation of a financial system, and any business for that matter can be called equity. Now, if Anand Rathi Wealth Limited is listed, which it is a different kind of a business. And the kind of diversification you get in equity, it's not one stock. It's not one kind of stock. It's not one sector of businesses. So that's why equity has the potential to help you fulfill most of the goals. The second part of the question, can you rely on past performance? The answer is no. Of course, you can't rely completely on past performance, because future is going to be different each time. But can you completely disregard past? The answer is no. Can you fundamentally disregard the principles of finance? The answer is no. A business equity has to do better than debt, right? If you borrow money from a company, if a company borrows money from a bank and then makes plant machinery and does a business, the return on equity has to be greater than the return on debt. That's when a smart owner of a business is going to borrow and invest, right? So point is, fundamentally, books will also tell you that return on equity has to be greater than return on debt. And if risk taking will not remunerate the owner of the business, then risk taking will collapse. And if risk taking collapses, the world collapses. So I think in the long run, equities have to outperform debt. And that's why it supports most of our goals as individuals. If you entrust a fund manager, who in turn entrusted to professionals who run those businesses of the stocks which he buys.
All right, Sridhar, I hope that answers your query. Also, for your funds, I would request you to send us your question again with your funds details. We have our last viewer on phone line, our Arunachalam from Coimbatore. Hi, good evening, sir. How are you doing? Hello, I think this is Mr. Tuhin Sarkar from Kolkata. Good evening, sir. How are you doing?
Good evening, all fine.
Thank you so much for sending us your query. We have your funds detail: Quant Infra, Quant Active, Kotak Equity Hybrid, Kotak Small Cap, ICICI Pru Multi Asset.
Exactly.
You want to be invested for how long?
I'm investor for last 3 years.
And for how long?
Another 3 years.
Another 3 years. All right, Feroz, more 3 years to this portfolio. How are the funds?
Kavita, I think Mr. Tuhin should change two things. One is the Corn Infrastructure Fund, which has done very well for him, but it's a sector fund. So it's on a principal basis, it should be an exit. Kotak Equity Hybrid Fund. Hybrid funds, at least in the new tax regime, will be beneficial. But I would say that mixing both debt and equity doesn't make sense. That's point two. ICICI Multi-Cap Fund could be exited. The schemes which he can enter in his portfolio as DSP Equity Opportunities, which is a large and mid-cap scheme. Franklin India Blue Chip, which is a large cap scheme. HDFC Flexi Cap, ICICI Proved Dividend Yield, ICICI Focused Equity, Kotak Emerging, and SBI Contra. These are the 7 schemes which he can note down. 3 of them which he is exiting, and 7 of them I have read out, which will give a very diversified portfolio, because all the schemes which I read out are from different categories and largely from different AMCs and fund managers too.
All right, I think that will be all. Mr. Mlachulam, is there anything else you want to ask Feroz?
Yeah, I want to ask one more question. Nowadays, bank interest rates has increased. Now, normal citizen gets around 8% from various banks. So, whether this SIPs are beneficial nowadays, seeing the interest rate increase in the banks?
Sure. Feroz, I'm running short on time, but then just 30 seconds.
Yes, Tuhin Saab, I think SIPs of equities don't compete with bank fixed deposits. So don't stop your equity SIPs, because the objective there is to make 13, 14, 15% per annum. So 0.5%, 1% move in interest rate should not change the direction of your equity investments. Having said which, on the debt side, whether given the tax rate changes and also the increase in the FD rates of 8%, even post-tax, I think quite a few FDs make more sense than pure debt funds in the current situation. But don't change your direction of equity investment at all with this increase in interest rate.
All right, with that, thank you so much, Feroz, being on the show and helping our viewers with their financial portfolio. And time for me to sign off, but then I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio-related queries. Thank you so much for watching. Goodbye.